Hello, in today's video we'll be taking a look at the Wednesday, October 15, 2025 trading session for the CBOE SPX index utilizing the day trading GPS SPX Daily Key Levels indicator, specifically the newest version of the indicator which came out a few weeks ago, the V2.0 version. Okay, so some of you may be already familiar with how this indicator works, but for those who are not familiar with it, I will briefly run through how this indicator works. So this indicator is for the TradingView platform only. So you do need to have an account with TradingView to use it, and that you will need to have the CBOE Global Indices data feed on TradingView, which I believe is still just $4 a month. Okay, so the way this indicator works, it works on two different symbols depending on how you're trading SPX. So if you're trading SPX index options, then you would use it on the symbol we have now, which on TradingView is the SPX symbol on the CBOE exchange. And when you have your chart on this symbol, then at 9:30 a.m. Eastern New York time, on the very first tick of the market open, you will get the daily key levels that are updated for today's session on your chart. The indicator also works on a second symbol, which I will take a pause here in the video and show you that chart. This is the second symbol that the indicator works on, the SPX 500 4x CFD, which is on the 8-cap exchange. So you would use your indicator on this symbol if you are, let's say you're on a FTMO trading challenge, or you're on one of these Forex broker trading challenges that only allow you to trade Forex CFDs or Forex currency pairs, and you want to trade SPX, then you would utilize this indicator for trading the Forex CFD, and you would utilize it on the SPX 500 8-cap symbol. Now, this 8-cap symbol also serves another purpose for people that are trading SPX index options on the CBOE index, in that while your indicator is on this chart, and you can have your indicator on both charts, you can simply just open up two different charts and have one with SPX 500 8-cap and the other one with SPX CBOE on the other chart. The reason that you might want to have it on this chart if you're trading SPX indexed options is that while it's on this chart, the SPX 500 8-cap, the levels are given at 9 a.m. Now the reason for that is because this Forex CFD trades in the overnight session as well as the pre-market session, and the way PineScript TradingView works is that even if your indicator that you've coded knows what the levels are going to be at a certain time, such as in this case 9 a.m. Eastern, then if that particular symbol is not open, which in that case at 9 a.m. CBOE SPX is not open because it does not trade in the overnight and it does not trade in the pre-market. So the only way that you can see the CBOE SPX key levels 30 minutes before it opens, if you'd like to see that and kind of get a jump on what you might like to do during the session, is we have this second table here while you have it on the SPX 500 chart, which will show you the CBOE SPX levels that will be in effect at 9:30 when it opens. You also have this table here for the symbol that you're on, which are these levels here. So these levels for the Forex CFD are going to be different than the CBOE SPX levels. But the advantage here is that if you want to have the second chart open, you can see the CBOE SPX levels 30 minutes early. Okay, so now we're back on the CBOE chart. So like I said, at 9:30 you will get the levels on your chart here for the CBOE SPX. One thing I want to mention, there's two things actually I want to mention briefly before we go on here. One is that we do have a complete features and setup video for this indicator, which will give you all of the different features of the indicator, and it will go over the indicator setup and show you all of the inputs in the user control panel, and it will go over explaining everything, how everything works, and then all the customization that you can do. That video is about an hour long. If you would like to see it, then you can simply email us at daytradinggps@gmail.com, and we will send you the link to that video so you can watch that. Also, if you do have an interest in purchasing the SPX Daily Key Levels indicator, then in return for you taking your time to watch this video today, you can send us an email at daytradinggps@gmail.com to request a discount promo code, and we will send you a discount promo code that will give you a substantial discount off of the regular purchase price. Okay, so at 9:30 a.m. Eastern New York time, when the SPX CBOE index opens up, you will get the daily key levels on your chart as you see here. You have the SPX pre-market high, SPX pre-market low, SPX YDH, which stands for yesterday's RTH session high, SPX YDL, which stands for yesterday's RTH session low, and YDC, which stands for yesterday's RTH session close. Those are also represented here on the line labels. Now you won't see YDL here, it is a little further down, but if we squinch this up, then you can see YDL here. It's recommended when you use this indicator, as we point out in the features and setup video, that since the initial part of the session is primarily going to be concentrated typically on R2 through S2, and then as we move throughout the session, then other levels can come into play, that you expand your levels out. Instead of having all these levels squunched up like this, you expand the levels out so you're seeing R2 through S2, or as you can see here, we've gone all the way down to S4, and that's because price action later on dictated that. But at the beginning, we just typically have R2 through S2 or R3 through S3, and that will give you a lot better look, more at the granular look at the levels for your decision making. Okay, so what are these levels? The SPX Bull Bear KPL, the KPL stands for Key Price Level. That is the indicator's all-important Bull Bear price pivot for today's session. So the indicator analyzes recent price action in recent days, as well as overnight and pre-market price action. Also, it takes into consideration current market dynamics, as well as current market volatility, and its algorithms come up with the bull bear key price level for today's session, as well as the other main R and S levels. So the main R and S levels here is by default they're going to be R1 through R6 and S1 through S6. R1 through R6 are above the BBKPL, and S1 through S6 are below the BBKPL. You also have these midpoint levels between the main levels. So for example, mid R1, R2, that's the midpoint level between the main R2 level and the main R1 level. The mid BBKPL R1 level is the midpoint level between the main R level and the main SPX Bull Bear Key Price level. And as you can see down here, for example, this mid S2, S3 is the midpoint level between the main S2 level and the main S3 level. Now on default startup, which this is also in the features and setup video, the levels that are turned on by default in the startup, which you can change the startup default if you want, if you prefer different levels to be shown on default. But when you first get the indicator, the default startup levels are going to be the bull bear KPL, and then R1 through R6, S1 through S6, and then you will have two midpoint levels turned on, the mid BBKPL R1 and mid BBKPL S1, and then you will have two QL levels, QL above BBKPL and QL below BBKPL. And you will also have these PMH, PML, YDH, YDL, and YDC levels. These tables here that you see are optional and can be turned off by you if you do not wish to see the tables on the chart, because you do have the line labels. Okay, so the other midpoint levels that you see here were turned on manually by us, as well as this QL below S3, which we'll get to why that was turned on here further on in the video. These midpoint levels serve several different purposes. One is to gauge continuing momentum in a move away from the bull bear key price level and between the main levels. The second purpose is that depending on what levels your trade is derived from, they can also serve as target exit points once your trade has reached a minimum level or exceeded that minimum level, which we'll also get to here in a second as to what that means. The third purpose is they are used as stop loss levels depending on the type of trade you're taking, bullish or bearish, and the trade that and the level that your trade is derived or triggered from. So for example, a bearish trade that's triggered and derived from the BBKPL level, the first midpoint above is your standard stop loss for a bearish trade triggered from this level. Whereas the QL level, their purposes are simply for tight stop losses. So if you don't want to use tight stop losses, then you can just simply turn them off, since the midpoints are used for the standard stop loss. But for those that prefer tight stop losses, the QL levels above and below are the tight stop losses. So for example, on a bullish play off of the bull bear KPL, the first midpoint level below the BBKPL is your standard stop loss on a bullish play from this level. Whereas in a bearish play from this level, the first midpoint above is the standard stop loss. And it's the same thing for the QL levels. If you prefer to use a tight stop loss on a bearish play from the bull bear KPL, then the QL above is your tight stop loss. Whereas on a bullish play from the bull bear KPL, your tight stop loss on that bullish play would be the QL below. Now you can also take bullish and bearish trades off of the other main levels, being the R1 through R6 or S1 through S6, as price moves on throughout the session. So you can also turn on the midpoints and QL levels for any of the other levels as well, depending on which ones you may be interested in focusing on for taking trades. Okay, so right now we'll just get into today's trades. So here we have the 9:30 a.m. candle marked off. We're on a 2-minute chart. Now with this indicator, it works on time frames of 1 minute to 30 minutes. So the maximum time frame you can use is a 30-minute chart time frame. If you try to put it on something above that, then there will be a message that will come up on the chart screen telling you to put it back within a 1 minute to 30-minute chart time frame. Now, Our strategies are primarily buying puts and buying calls. Just simply buying puts for bearish plays and buying calls for bullish plays. So for that strategy of simply buying calls on bullish plays and puts on bearish plays, the 2-minute time frame we have found to be the best time frame to utilize with this indicator for that purpose. Now, other people have other different types of strategies and option strategies that they will use, which could be a myriad of different things. It could be butterflies, it could be iron condors, it could be any other type of combination trade that involves selling and buying various combinations of calls and puts, or it could be just a bullish spread or a bearish spread. And there are, as many of you may know already, there are tons of different types of option plays. If you look at our videos, we primarily just focus on simply buying calls on bullish plays and puts on bearish plays. You can use this indicator for other types of option trades, and if you do so, you may want to use a different time frame for those instead of the 2-minute time frame. So like I said, it does work on time frames of up to 30 minutes. So other types of strategies are better suited for longer time frames in an intraday session, but as far as just simply buying calls on bullish plays and simply buying puts on bearish plays, we have found that the 2-minute chart time frame works best. However, other time frames that work on for that as well would range from 1 minute to 5 minutes. But if you look at our other videos, you always see that we use the 2-minute chart time frame. Okay, so here we have the 9:30 a.m. candle marked off here for today's session. As you can see, it opened below, pretty substantially below the bull bear key price level for today's session. So it opened below, it had a small wick above and a small wick below. It was fully contained below the bull bear key price level, and it also closed below the bull bear key price level. So that is your bearish bias for the session on this opening candle. And that is also, if you want to take a trade off of the 9:30 a.m. candle, that would be your bearish entry signal. So remember that the 9:30 a.m. candle, the opening candle, is always going to be its relationship to the bull bear key price level. So on opening candle trades, the level that you're trading from is always going to be the bull bear key price level. Now as we move throughout the session, that's going to change. But if you're inclined to take trades on the 9:30 a.m. opening candle, then the trade is considered derived from the bull bear key price level, which is important because that determines what strike you're going to use and also what your stop loss options are going to use, as well as what your target exits or minimum target exits are going to be. Okay, so how do you determine what strike to use on this bearish play? Okay, so first we look to the level that we're trading from. That's the bull bear KPL, 66.9780. So the standard play in this strategy is that you use the at the money option strike that is closest to the level that you're trading from, that the trade is derived from. So in this case, 6,700 is the closest strike to 66.9780. For those that may not be familiar with how SPX options work, SPX options trade in 5-point increments. So for example, 6690, 6695, 6700, 6705, 6710, etc. So the closest strike to this bull bear KPL is going to be the 6700 strike. This is a bearish play, so it's a 6700 put option. The entry price on this candle close, which this candle opened at 9:30 and closed at 9:32, is $21.63. So one put option is going to cost you $2,163. If you're not familiar with how options work, you simply take the price of the option and multiply it times 100, and that is the cost of the option. So if you were trading 10 of these, then you would multiply this times 100, 2,163. You're buying 10 of them, so it's 10 times that, so that would be $21,630. If you're buying 2 of them, then you just multiply 2,163 times 2. If you're buying 5, you just multiply it times 5. In this video and all of the examples that we're showing, this is just trading one option. Okay, so that is how you determine which strike to use. Now, for those that want to use out of the money strikes, you can use out of the money strikes within certain limits. And we're not going to go into that in this particular video. You can watch any one of the last 7 or 8 videos that we've made on this channel over the last 10 to 12 days, and we go over in those videos how to choose the out of the money strikes that you're allowed to use based on the level that you're trading from. But in this video, we're not going to go over that. Okay, so how do you determine your stop loss on this? So this is a bearish play. So as we mentioned earlier, on a bearish play off of the level that you're trading, it's the first midpoint above the level you're trading. This is the level we're trading from. The first midpoint is this, mid BBKPLR1, 6707.63. If you prefer a tight stop loss, then you use the first QL above the BBKPL because that's the level we're trading, and that is 6702.72. Just an FYI, we typically recommend that you use the standard stop loss. If you want to use the tight stop loss because that's the way you'd like to manage your risk profile, there's nothing wrong with that, but just be aware that if you do use the tight stop loss, it is more prone to getting stopped out. Although in today's session, both of them would have gotten stopped out, as we'll see here in a second. So, but just keep in mind, if you do use the tight stop loss, you'll have less money at risk, but it's also going to be more prone to getting stopped out. All right. So you have our entry. As you can see here, after some sideways action and then a little movement downward, we did get stopped out. So here's the QL level. So you would have gotten stopped out on the tight stop loss on this candle, which is the 9:54 a.m. candle. But since we used the standard SL, then you got stopped out here on the 9:58 candle right here, which is this little sliver of a candle right here between these two green candles that has a very small red body. So maybe a little hard for you to see. Could maybe move this out. Anyway, it's this candle right here, the 9:58 candle. Now on this candle, the stop out price was $13.33. So that's an $830 loss. So that's simply taking $21.63 minus the $13.33. So it's a loss per contract of $830 because remember, our cost per contract was $2,163. So here we're getting out for $13.33. So the loss is $830. At this point, though, we still had, as I mentioned earlier, we had a open way below the bull bear key price level. We had containment below, so this wasn't like it was a very long wick above and then it just happened to close below. And we had containment here, and it also closed below. So we have a bearish bias for the session. We now have a loss on the session in this first trade. And what we're looking for here is we're either not going to trade the rest of the day, because that's part of risk management as well. So your one choice that you can make is, if the first trade is a loss, you can just simply not trade for the rest of the session and just wait for tomorrow's session to come up when everything will be completely different, and just look forward to doing that. If you are going to trade throughout the rest of the session, then what you're looking for is what price reaction is going to happen once we hit the bull bear key price level again. Now, that doesn't mean that price is going to retrace to the bull bear key price level. Price could have kept going up, and in that case, if you still want to trade the rest of the day, then you can take a look at trading one of the other main R levels above, and whether you would like to take either a bullish or bearish trade off of those levels. In this case, though, since we have a pretty firm bearish bias here, even though that was we did get stopped out because it did move above, we also have a huge gap up from yesterday as well. And as many of you know, sometimes we have gap and goes that don't fill, but there are a lot of times on SPX where gaps do fill intra-session, and then they can make a resumption in the direction of the initial gap. So that's also something that you also have to keep in mind, that we did have a very large gap up. So we do have this bearish bias. So here on the 11:32 a.m. candle here, we do get a decisive close below the bull bear KPL. So we have a cross below and a close below on the 11:32 a.m. So here you would use the same strike, because now this is the same level that we're trading off of, the BBKPL 66.9780. So we're going to use the same 6,700 put option. The entry price on this candle close of this 11:32 a.m. candle is $15.90, and we'll be taking a look at the data boxes for the 2-minute chart for these options when we get through this part of the video, so you can validate all these different prices. And we're going to use the same stop losses as we did before. Since this is off of the same level, it's a bearish play, it's the same stop losses. First midpoint above is the standard stop loss, first QL above is the tight stop loss. But as you can see, in this particular case, neither one of those was breached, as we got a continuing move down. Okay, so now we're going to get into target exits. That's going to depend on what kind of trader that you are. So if you are a scalper, the way you use this indicator, if you're just scalping, is you're looking for a one level move only from the level that you're taking the trade at to the target exit. So in this case, the level we're taking the trade from is the SPX bull bear key price level. It's a bearish trade, so we're looking for one full level for an exit. One full level below is the S1 level. Now, as you can see here, you may not be able to see it on your screen. It came very close in these two candles to hitting the YDH level, but then here on this candle here, it hits finally the S1 level and breaks below the YDH level, all in the same candle. It did wick below the S1 level as well, but as you can see here, it does touch it and also went through it and closes right on the level. So this would be where your exit would be for a scalp. And on scalps, there is no adjustment of your stop loss. When it hits this level, you're simply closing out 100% of your contracts, whether you're scalping 1 contract, 3 contracts, 10 contracts, or more. Now, for those of you who like to do regular trades where you're looking for a bigger profit, a bigger move, and also the ability to, if you're trading multiple contracts, to be able to scale out of contracts and adjust your stop loss on remaining runners, then the minimum move you're looking for is a 1.5 level move. That is the minimum target move you're looking for. The ideal minimum target move is going to be a 2 level move, whereas the minimum is going to be a 1.5 level move. So how we determine a 1.5 level move is we look at the trade we took, the level we took the trade from, in this case the bull bear KPL. This is 1 level below, and then we just look to the half level below that. That's 1.5 levels. So it hits the 1.5 level mark here on the 11:50 a.m. candle. It hits the mid S1, S2 level. That's the regular trade minimum 1.5 level move. And you close out 100% of your contracts. So your choice is either closing out 100% of your contracts. So if you are trading 1 or 3, 4, 5, 10, 20, however many, you can just close out all of them if you wish. But if you're trading multiple contracts, say 4 or more, you would close out 70 to 90% of those. So for example, if you were trading 5 contracts, you would sell 4, that's 80%. If you were trading 4 contracts and you sold 3 of them, that's 75%. 3 is kind of a gray area. If you sold 2 of them, that's a little bit under 70%. It's roughly 67%. If you had 10 contracts and you could sell 7 or 8 or 9, that would be 70 to 90%. And then you adjust your stop loss on the remaining runners. So how you're adjusting your stop loss when using this indicator at this point is to begin with your stop loss as a level. However, when you adjust your stop loss, when it hits the targets, you are adjusting your stop loss by then doing it by price. So how you do it by price is you're simply adjusting it to at least break even, meaning you paid $15.90. It's now $37.55 on this candle close. So you would at least be adjusting your stop loss to $15.90, or you add a 10 to 15% profit buffer above $15.90 to give you a profit cushion should price retrace. That way, at least you're not out break even. At least you have still a 10 to 15% profit. But what you're looking for in that is that you're looking for it to continue to move down, because if you're not looking for it to continue to move down, then you might as well just close out 100% of them. So the only reason to scale out and leave remaining runners with an adjusted stop loss is you're looking for a further move down, and then you would then either close out or further adjust when it hits different levels if it continues to move in your favor. If you're not looking for it to move down further, then there's no reason to do an adjustment or scale out, just close out 100%. Okay, as we said, this 6,700 put is now 37.55 on the close of this candle. The profit on this trade is now $2,165, but remember we had an $830 loss here, so now our net P&L is $1,335. So remember, these are based on one contract. So if you were trading multiple contracts, then you would just multiply that by however many contracts you're trading. Okay, so we did get a retrace here. However, remember that if you adjusted your stop loss to break even or a 10 to 15% buffer, you're not getting stopped out here. So that's why you, on your first adjustment, you don't make the adjustment where you're adding some 50% profit buffer, because that's just too much. You add a minimum profit buffer, if you're going to add one at all, of 10 to 15%. So that would mean in this case $15.90. If you're adding 10%, that's roughly $1.60. So you add $1.60 to $15.90. If you were making 15%, that would roughly be $2.40 that you would add to $15.90. Then as price moves further in your favor, and if you're not going to close out your runners as price continues to move in your favor when it hits the different levels, as you'll see in a second, then you would add more of a profit buffer on each successive level move down until you've reached the point where you feel that you've made enough profit and you just want to close out 100%. Because remember, nothing is going to continue to go down. Very few days you're going to see something just move in one continuous direction. We do have days like that where they're just trending days to the point where there's hardly any retraces at all, and price just ends up on the higher low of the session without very many retraces in the opposite direction whatsoever. So price does like to zig around. The market is made to trick, trap, fool, and frustrate as many traders as possible. So those types of days where it just moves in one continuous direction with hardly any retraces at all, they do happen, but they don't happen that often. All right. So we can see here on the 1 p.m. candle, we get a kind of a gigantic candle here that flushes through S2. On this 1 p.m. candle, it hits the S2 level, closes through it. This is the ideal two-level move because now we've moved a full 2 levels. So our bull bear key price level to S1 is 1, to this midpoint is 1.5, S2, that's 2 levels. So again, close at 100% or scale out and adjust stop loss. The 6700 put is now 48.60 on this candle close. The profit is now $3,270 per option. The net P&L after subtracting out our loss earlier is now $2,440 per option. Okay, so price continues to move down and starts accelerating. As you can see here, it slices right through yesterday's daily close. And it hits our next level down, the mid S2, S3 level. So now this is a regular trade 2.5 level move because we had the 2 level move to here, now another half level, that's 2.5 levels. So again, close out 100% or scale out and adjust stop loss remaining runners. 6700 put is now $60.25 on this candle close. As you can see, this candle close, it backed off slightly from the mid S2, S3 level in the close after wicking through it. But on the candle close, it's now $60.25. The profit is now $4,435. The net P&L is now $3,605 per put option after we subtract out our loss earlier. And it wasn't through yet. Got another large candle here, then a little pause here, another large candle here on the 1:14 p.m. candle. Slices through the S3 level, closes below the S3 level, 1:14 p.m. candle. This is now a 3-level move. From bull bear to S1, 1 level, 1.5, 2, 2.5, 3 levels. The 6,700 put is now $86.66 on the candle close here. The profit is now $787,836 per put option. And the net P&L after subtracting out the loss of $830 is now $7,006 per option contract. Now, for those that were looking for a bullish trade, once this bottoms out, this is a pretty fierce move here, especially this part right here. This is just simply 1, 2, 3, 4, 5, 6, 7, 8 candles. This is basically 15 minutes. It's moving from about 66, 64 down to 66.12. So that's over 50 points in 15 minutes. That's a pretty fierce move down. Now, from the bull bear key price level at almost 6,700, you know, that's about 90 points right here. So again, this started at 11:30. This is 1:15. So that's roughly an hour and 45 minutes. Moves almost 100 points. Okay. So right here, in most cases, when it reaches the S3 level, we've had a 3-level move. You could continue to adjust your stop loss if you're still in this trade and you haven't closed out your remaining runners to see if it's going to go down further, and even go to mid S3, S4, S4, or as we saw earlier, even yesterday's daily low. For those of you that were looking for a bullish trade, then this is your signal right here for a bullish trade. So again, if we hit right here, and it's now 86.66. If you're still in this trade after making all this profit with remaining runners, you've adjusted your stop loss. You more than likely should have adjusted your stop loss on 86.86 when it gets down to this level to somewhere in the 60s, say for example back here when it was back here. So if you're adjusting it to 60, then you're going to get stopped out, and then your remaining runners get sold at 60. Or you're closing out at 100%. Now, when it starts accelerating like this, you can, like I said, add on the profit buffer as you wish. One recommendation is that you, for every 1 to 1.5 levels, okay, then you're making another adjustment, say, of what the previous price was on the previous target level. So for example, that's what I was talking about here. This was the previous one. This is where we are now. So if you adjusted it to 60 when it's at 86.66. However, if you want to be more conservative and say, okay, it's at 86.66, I'll just make it 80. That's perfectly fine. I mean, you have so much profit built in, and now that once it gets accelerating down to this point and you have that much profit built into it, that you don't really need to be as liberal with your stop losses at this point as you would, say, at the initial adjustment that we talked about when it hits the minimum level here. Okay, for those looking for a bullish entry, we have this big breakup candle here above S3. This is coming after a pretty solid move down. So here, if you wanted to take a bullish entry on this 1:16 p.m. candle, then the trade that you're taking the level that you're taking the trade off of is the S3 level, 66.19. So this is a strong candle close. That's a cross above, close above S3. So the 66.19.15, the strike closest to that level is going to be 66.20 call, because that's the closest at the money strike to this level. So if you took this bullish trade, it's going to be the 66.20 call. The price on the candle close here was $23.84. Your standard stop loss on this bullish trade is going to be the first midpoint level below the level you're taking the trade from, that it's derived from, which would be this level here, the mid S3, S4, 65.99.49. Or your tight stop loss is the QL below the level you're taking the trade from, and that, because it's a bullish trade, so that is the QL level below S3. So in this case, 66.09.32. So as you can see, neither one of those came close to being breached in this case, and we got a pretty striking move back up. You'll see this kind of move happen a lot in SPX, where you'll get a move down like this, and then it goes up to challenge where the move started really accelerating from. Doesn't happen all the time, but it does happen a lot of times. Okay, so here you have the same situation. So let's say you were just scalping off of this S3 level. Well, then you're just looking for a one level move, just like we talked about up here. A one level move here is going to be from the level that you took the trade from, S3 to S2, because that's one level. This mid S2, S3 is a half level. This is a full level. And then this is your 1.5 level, and this is your 2 level move. So if you were just scalping, then you would get out here when it hits the 1:48 p.m. the S2 level. However, if you're taking in the regular trade, then you would do the same thing we talked about before. You're waiting to the 1.5 level move minimum target, which happens on this candle here, the 214 candle. So the bullish entry off S3 hits mid S1, S2. That's a 1.5 level move. Now you're doing the same thing, closing out 100%, or scale out 70 to 90%. Adjust your stop loss to break even, or break even plus 10 to 15% profit buffer on remaining runners. The 66.20 call is now $47.10 on the candle close. The profit on this trade is $2,326. At 2:56 p.m., the bullish entry off of S3 now hits the S1 level, as well as the YDH level. So we've gone all the way back up to yesterday's RTH session daily high. And we also broke above the pre-market low. And this candle here is the 2:56 p.m. candle, where it takes out the S1 level and then touches the YDH level. So this is your regular trade. This should say ideal minimum 2 level move, just like we said here. So sorry for that typo. Close out 100% or scale out 70 to 90%. Just stop loss remaining runners. The 66.20 call, now $60.10 on the candle close. The profit is now $3,626 per option. Okay, for those that would like to stick around after I show you the data boxes for the Thinkorswim options, for the 6700 put option and the 66.20 call option, there'll be about a 25-minute section which will be added onto this video for the end of this video, which will go over a couple things. It goes into more detail about taking trades off of the other bullish and bearish trades off of the other main R1 through R6 and S1 through S6 levels. And it will also go over the two different types of trade entries, which would be your standard trade entries and what to look for and how to recognize those, and then also the more conservative trade entries, which take more confirmations, and how to recognize those and what to look for in those. Okay, so now we're going to pause and we're going to take a look at the two option charts. Okay, first we're going to look at the 6700 0DTE put option for today's session. Here we have the 9:30 a.m. candle close below the BBKPL. That's entry 1, $21.63. Here is where we got stopped out on the standard stop loss at the 9:58 a.m. candle, and we're getting stopped out on the close of that candle. You could also look at it as the low of the candle. However, if you remember, the low of that candle was pretty far above the standard stop loss level, so you would probably just look at getting stopped out somewhere between this close and that low, but very likely in the close level if you look at the open, high, low, and close here. But even if you'd like to look at it as getting stopped out on the low, then there's about $106 difference. So if you want to look at it like the worst case scenario, that you instead got stopped out on the low, then instead of the $830 loss, then just simply look at it as a $936 loss, because there is a $106 difference. Okay, so here is the 11:32 a.m. candle close below BBKPL. So this is put entry number 2, $15.90 on that candle close. Here's the 11:40 a.m. candle where it hits S1. So that's if you're just scalping. The close of that candle was $27.30. So if you were just scalping, then that would have been your profit on that, the difference between the $15.90 and the $27.30. Here we have the 11:50 a.m. candle close, hits mid S1, S2. This was the regular trade, minimum 1.5 level move, close out 100% or scale out 70 to 90%, adjust your stop loss on remaining runners. The close of this candle, 37.55. Here's where it hits S2. So I apologize again for the typo here. This should just say S2. If you go back and look at the video, you'll see that on the 1 p.m. candle it hits S2, so my apologies for my typo here. This is the ideal two level move, close out 100%, scale out 70 to 90, adjust stop loss remaining runners. Close of this candle 48.60. As you can see, it did wick up pretty close to the mid 50s, high 52.52, but we're going off the close of the candle 48.60. Same thing here with this one. As you can see, this high was 42. Again, we're just going off the close. Here's the 108 candle. This hits the mid S2, S3, 2.5 level move. So as you see here, this hit a high of 63.29. The close of this candle, $60.25. Here's the 1:14 p.m. candle where it hits S3. That's a full 3-level move. As you can see here, the high of this candle is also the close of this candle, 86.66. Now we'll look at the call option. Here is the 66.20 call option. Remember, this is the play off of S3. 1:16 p.m. entry on close above S3. That was the very strong breakup candle above S3. And after that long downturn, 1:16 p.m. close of this candle 23.84. Here's if just scalping. This is where it hits S2. Remember, this trade was derived from S3, so this is a one level move from S3 to S2, met for scalping and 100% closeout. Remember, on scalping there is no stop loss adjustment. You're just simply, no matter how many contracts you're trading on a scalp, you're just closing them all out. So here the close is $40.39. We paid $23.84. So that's approximately $1,650 or so per contract. Okay, at 2:14 p.m. SPX hits mid S1 S2. Remember, that is the minimum regular trade 1.5 level move, met from starting from the S3 level where the trade was derived from. So S3 to mid S1 S2, close of the candle $47.10. So now we're up to approximately just under $2,400 per contract. And at 2:56 p.m. hits both, I'm sorry, another typo here, this should not say mid. It hits both S1 and YDH. This is the ideal minimum regular trade 2-level move, met from S3 entry level to S1. And the close of this candle, $60.10. So from 23.84, we'll just round it off to 24, just for simplicity's sake, 24 to 60. So that is $3,600 per contract. Okay, as I mentioned earlier, if you are interested in purchasing this indicator, you can send us an email at daytradinggps@gmail.com. In return for you taking your valuable time to watch this video today, you can request for us to send you a discount promo code to give you a substantial discount off of the regular price for the SPX Daily Key Levels indicator. And now, if you'd like to stay around, there's going to be an appendage to this video, which is going to be a 25-minute section on taking bullish and bearish trades off of the other R1 through R6 and S1 through S6 levels, as well as the two different types of trade entries, the standard trade entry as well as the more conservative trade entry, which takes additional confirmations, and how to recognize and use both of those. Hello, in this video we're going to go over how to take trades off of the other main R and S levels. So this would be taking trades off other levels besides the bull bear key price level. So the main R and S levels are your R1 through R6 and S1 through S6. So if we zoom out here, we'll have R1 through R6, S1 through S6. The levels that show up as default on startup with this indicator are the PMH, PML, YDH, YDL, and YDC. So that's the pre-market SPX pre-market high, SPX pre-market low, SPX previous day RTH session high, SPX previous day RTH session low, and SPX previous day RTH session close. So the previous days are YDH, YDL, and YDC. So that's yesterday's high, yesterday's low, yesterday's close. PMH and PML are the current session's pre-market high and pre-market low. So pre-market high, pre-market low, YDH, YDC. And we move down, here's the low from the previous RTH session. Also in startup, you will have R1 through R6, the bull bear key price level, and S1 through S6. You will also have QL above BBKPL, QL below BBKPL, the first midpoint above the BBKPL, and the first midpoint level below the BBKPL. And this is because in 95% of the sessions or so, your trades at the beginning of the session, if you decide to take trades at the beginning of the session, are primarily going to be based on price action at the bull-bear key price level. However, there is no rule or obligation to take trades off the BBKPL. It is there for the session bias, to give you a bullish or bearish bias for the session, as well as the trades that you can take at the beginning of, like I said before, 90-95% or so of most sessions that you will see. However, you can just wait until price action bears out further on in the session and take trades off of the main R levels or S levels. As we've discussed in other videos, when you're taking a bullish trade off of the bull-bear key price level, your tight stop loss is the QL below the BBKPL on that bullish trade triggered from the BBKPL level, and your standard stop loss is the first midpoint below, which would be mid BBKPL S1 for a bullish trade taken off of the BBKPL level. Conversely, on a bearish trade taken from the BBKPL level, your tight stop loss is the QL above the BBKPL, and your standard stop loss for a bearish trade taken off of this BBKPL level is the first midpoint above the BBKPL, which is mid BBKPL R1. The same principles applies to taking trades off of the other levels. So if you're going to be taking trades off the other levels, then you simply need to turn on the quarter levels if you're going to be considering taking tight stop losses, or the midpoint levels for standard stop losses. So for example, if we're looking to possibly take bullish or bearish trades off of R1 or R2 or S1 or S2, then we would simply turn on the QL levels above and below those levels, as well as the midpoint levels. So you simply go into the user control panel, and first we'll turn on the midpoint levels. So we'll enable mid R1, R2, mid R2, R3, mid S1, S2, and mid S2, S3. And let's say we're also considering tight stop losses. Then enable QL below R1 and above S1, below R2 and above R2, and then the same thing for the S levels. Above S1, below S1, above S2, and below S2. Now you can leave it this way if every day that you want to consider taking trades off of this level. Just know if you reset the settings, it's going to go back to what I showed you before as the default. So for example, right now we're just showing R3 through S3. So for example, if price is coming down to S1 and bouncing off of S1, and you want to take a bullish trade off of S1, then your tight stop loss on a bullish trade is the first QL below S1, because S1 is the level that you're taking the trade off of. And the standard stop loss would be the first midpoint below S1, which would be mid S1, S2. So instead of a bounce off of here, if price came below here, then went back up and crossed above and closed above, S1 and you wanted to take a bullish trade off of S1, it would be the same thing. You're taking a bullish trade off of S1, so your tight stop loss is to QL below S1, and your standard stop loss, if you choose that one instead, is the first midpoint below S1, mid S1, S2. Let's say the reverse happened. Price is slicing through S1 and closing below S1. And you want to take a bearish trade off of S1. Then on a bearish trade from S1, your tight stop loss is the QL above S1. And on a bearish trade on S1, your standard stop loss is the first midpoint above S1. So always just remember that on bearish trades from any level, your tight stop loss is going to be the first QL above that level, and your standard stop loss is going to be the first midpoint above that level for bearish trades taken from that level. And on bullish trades taken from any main level, your tight stop loss is going to be on bullish trades taken from the main level, your QL below that level, and your standard stop loss is going to be the first midpoint below that, whatever level that is. So on R1, if we were taking a trade of a breakout above R1 and we're taking a bullish trade, then our tight stop loss is the QL below R1, because that's the level we're taking the trade from. And our standard stop loss, if we choose that instead, is the mid BBKPL R1, because that's the first midpoint below the level we're taking the bullish trade from, R1. If we were taking a bullish trade on a breakout above R2, then our tight stop loss in that bullish trade on a breakout above R2 is QL below R2, and our standard stop loss on a breakout above R2 is going to be the first midpoint below R2, which is mid R1, R2. Now, in the reverse, let's say that price goes up to R2. Now it starts closing below R2, and we're looking for a bearish trade off R2 to move down below to these levels below. On a bearish trade from R2, then our tight stop loss is the first QL above R2. If we choose instead to use a standard stop loss for our bearish trade taken off R2, then the standard stop loss is the first midpoint above R2, which is mid R2, R3. Same thing if we're taking a bearish trade off of R1. If we're looking for a bearish trade off of R1 or break below R1 or a touch and fall off of R1, then our tight stop loss on the trade taken from the R1 level is the QL above R1, and our standard stop loss on this bearish trade taken from R1 is the first midpoint above R1, mid R1, R2. Same thing applies to the S levels on bearish trades. If you're taking a bearish trade based on price action coming down, closing below S1, then your tight stop loss in that bearish trade taken from the S1 level is QL above S1, and your standard stop loss is the midpoint level, the first midpoint level above S1, which is this mid BBKPL S1. On a break below S2, then a bearish trade taken from S2 is the tight stop loss for that. On a bearish trade taken from S2 would be the first QL above S2 here, and your standard stop loss would be the first midpoint above S2, which is mid S1, S2. Same thing applies on S3 levels. If this was a bearish trade we were taking because price started closing below S3, so on a break below, close below S3, our tight stop loss would be the QL above S3, which we don't have because we didn't enable it on this chart, but it would be the first QL above S3, or if instead you're choosing to take the standard stop loss for your trade on a bearish trade from the S3 level. Then it's the first midpoint above S3, which is mid S2, S3. Same thing for a bullish trade above R3. Break above, close above R3, then your tight stop loss would be the first QL below R3, because we're taking a bullish trade looking for price to go up, continue going up. So you would enable QL below R3 if you want to use a tight stop loss. Keep in mind that if you're just using standard stop losses, then unless you have some reason why you want to see where the QL levels are, there's no reason to turn them on. So if you're just going to be using the standard stop losses, then you would just want to have your midpoint levels turned on, unless for some reason you also want to see, just for context, where the QL levels are. So again, in summary, if you're taking a bullish trade off of either the bull bear key price level or any main level, whether it's an R level or an S level, if it's a bullish trade, then your tight stop loss, if you choose to use that, is the first QL level below the level that you're taking the trade from, and your standard stop loss is the first midpoint level below the level you're taking the trade from. The opposite is what is on bearish trades. On bearish trades, then if you use a tight stop loss, then it's the first QL level above the level you're taking the trade from. If you're taking a bearish trade and want to use a standard stop loss level, then your standard stop loss level is the first midpoint above the level that you're taking the trade from, the bearish trade from. Bearish trade from R1, standard stop loss is mid R1, R2. Bearish trade off of R2, looking to go down, your standard stop loss is mid R2, R3. Bearish trade from the BBKPL, your standard stop loss is the mid BBKPL R1, because that's the first midpoint above it. A bearish trade taken from the S1 level, your standard stop loss is the first midpoint above S1. And again, on bullish trades, it's the opposite. It would be the first midpoint below. So if you're taking a bullish trade off of S2, first midpoint below S2 is your standard stop loss. Okay, so now we're going to take a look at examples of both standard and conservative entries, both on bullish entries and bearish entries. So first off, we're going to look at bullish entries. So here we have a cross above and close above. So we have a candle that the same candle is crossing above the level in question, in this case the bull bear KPL, but it would not matter what level it's on. So regardless of what level this is, you have a cross above and close above the level. That is your bullish entry on a cross above and close above the level in question. Your second option is take a more conservative bullish entry approach. And on the more conservative bullish entry approach, you are requiring a retest of the level, a successful retest of the level before entering your trade. So in the case of a bullish trade, you're waiting for a successful bullish retest of the level in question before entering your bullish trade. So on this more conservative option, the sequence is you have a cross above and close above the level, which we have here, followed by price falling back to test the same level successfully, meaning it's coming back down, it's not closing below the level, it's successfully retesting the level and closing above the level. So it's cross above, close above, fall back to retest on a bullish trade, close again above that level, that is your conservative bullish entry that requires a retest. Just keep in mind that if you are going to focus and use the more conservative bullish entry that requires a retest, that many times price, after initially crossing above and closing above, will just continue to keep closing above in successive candles, and there will be no retest. So just keep in mind that if you use the more conservative entry, there are going to be times where you are going to miss entries because there is not going to be a retest. In this case, there was a retest. So again, just to go over it again, the standard bullish entry is a cross above and close above the level in question, in this case the BBKPL. So you would enter on the close of this candle here. Or if taking the more conservative bullish entry approach, you're waiting for a successful retest for price to fall back to the level in question, but still close above the level in question, and that is your successful retest. So you would enter, you could have entered on this candle, or if you did not on those, you could have entered on this candle here, and it did retest the candle here. We had a retest here, but if you waited for this retest, you'd be paying a lot more. So usually the successful retest, you're just waiting for the initial successful retest. So this is the initial successful retest. This is the initial cross and close above. This is the initial retest. Okay, so just to take this one step further here, so as you can see here on the R1 level, we had a cross above and close above this level. So if you missed this entry here, or if you're just the kind of trader who you prefer taking trades off of other levels besides the bull bear key price level, then you have a cross above, close above here, and you would take that entry here, and you would base your entry on the R1 level. Now, just to clarify, the stop loss on either one of these entries here, down here, whether you took this standard bullish entry or the more conservative retest required bullish entry, your standard stop loss is the first midpoint level below the level in question you're taking the entry from. So in this case, on this sequence here, this is taken from the bull bear KPL, so your standard stop loss is the first midpoint level below the level in question, the bull bear KPL, so that is this level here. We don't happen to have the quarter levels on this particular chart, but if you instead wanted to use a tight stop loss level, then you would enable the QL below the bull bear key price level, and that would be your tight stop loss on this trade. And the QL is the midpoint between the midpoint and the main level. So on the new version, the 2.0 version, you have the auto plotting of the QL levels if you simply enable them. But here, as you can see, the tight stop loss would not have been hit either. But just keep in mind that on any entries, whether it's bullish entries or bearish entries, the tight stop loss is named a tight stop loss because it is tighter and there's more chance that it will be hit than the standard stop loss. So if you're going to use the tight stop loss, you're going to have less at risk because you're using the tighter stop loss. But conversely, the con side of that is that there's more chance of it getting hit. So you just have to be mindful of that. If you had instead, like the second point we're getting at, if you waited to take an entry off of the R1 level on this cross and close above, then your standard stop loss on that trade is the first midpoint below the R1 level, which is this mid BBKPL R1. And if you instead took the tight stop loss, then it would be the QL below the R1 level, which would be the midpoint between this level and this level, which again, on the new V2.0 indicator, those auto plot as well, the QL levels. Okay, now we'll look at a bearish entry. Your standard bearish entry, you enter a bearish trade on a cross below and close below level. So here we have a cross below and close below the R2 level. So you would enter a bearish trade on this cross below and close below if you were looking to take a trade off of the R2 level and you were open to bearish trades off of that level. This would be your signal to take the bearish trade on a standard bearish entry. Your standard stop loss on this bearish entry is the first midpoint level above the level you're taking the bearish entry from. Since the bearish entry is from the R2 level, your standard stop loss is the first midpoint level above the mid R2, R3 level. And if you chose instead to use a tight stop loss level, then it would be the QL above R2, which in this case would be about right here. And again, on the new V2.0 indicator, it will auto plot that level for you if you go ahead and enable it. Now, looking at the more conservative bearish entry, it's just like the bullish one that we did, except in reverse. We're waiting for a successful retest of this level before entering the bearish trade. So in this sequence, it's basically the reverse of this sequence down here for the bullish entry. In this sequence, we have a cross below, close below candle. Then price rises back up to test the level in question and then closes below that level again. That's a successful retest of the level. So this is where you would enter on a successful retest. You could have also entered here. That would have been a little bit later, but that, either one of these candles here would be considered the successful retest. So even on the successful retest, since it's off of this level, it's the same stop loss. First, for a standard stop loss, the first midpoint level above, which is mid R2, R3, that's the first midpoint level above this R2 level. And if you chose to use a tight stop loss, it'd be the same as what we talked about with the standard entry. It would be the QL above R2. And the same thing would apply for any other level. So if this price action was happening down here on this S2 level instead of here on this BBKPL level, then it would be the same sequence. Cross above, close above, that's your standard entry. Cross above, close above, then retest and close back above, that's your conservative successful retest entry. And then your standard stop loss on an S2 level bullish entry is the first midpoint level below S2, which is mid S2, S3, and then your tight stop loss level on a bullish trade taken from the S2 level is your midpoint, the QL below S2. Okay, I hope this clarifies the entries and also taking entries from the different levels for you. Thank you.